Everybody knows we are going to be, this is a live broadcast to all of our channels that we go outbound with. Just have that in mind if you're sharing questions, etc. Be something that you're comfortable in speaking to. I'm not saying this to make you nervous or anything, but just know that it is live. So no swearing at me while we're live, Zach. I'm speaking to Zach.
Oh no, poor guy.
This is something we started, as many of you know, in March of 2020 upon the setting of COVID, because we used to be in the webinar business. So we sold real estate by educating people live, one-on-one, 10 to 1, 50 to 1, 100 to 1. We got to the point where we were renting out Schulich up at York University and doing presentations there. And then all of that came to an abrupt end. And we had to figure out our digital selves. So now we have typically, from the time we shoot live, with 300 to 500 people across different channels. But over the first week, we have 2,000 to 5,000 people typically that watch it. And then within 30 days, probably close to 20,000 people is the entire reach of any one brunch. So with that said, welcome. And are we live, Stephen? Good morning to our amazing REC insiders. Welcome to another edition of REC Brunch. Today I'm here with Bobby Pume, who is our Director of Team Operations, and also the gentleman who helps myself, Jazz, Laura, Tyler, design the processes of due diligence that we are known for. And today we are going to be diving very much into exactly that. For all of those online from coast to coast, please feel free to tell us where you're logging in from. Good morning from Mississauga, Ontario. We are in the west side of the GTA today to accommodate some of our insiders who are in the Hamilton, Oakville, Burlington, and of course Mississauga areas. And Brampton. Nobody forgets about Brampton.
Never.
Not today.
Not today.
Every other time we do, but not today. All stuff aside, welcome everybody from coast to coast. Today was a very much in demand episode. Tyler, a few weeks ago, did something similar. For those who don't know Tyler, he's our Director of Concierge Services and Coaching Services for our insiders. And he had, out of nowhere, almost 200 people join him on a call that was about doing exactly what we're going to do today. Take a look at how we analyze and how you can analyze a property using a resource provided to you by our team that is easy to use and easy to learn how to use. And what we're going to do today is exactly that. We are going to use it live in front of you, where you can actually take the steps, learn it, use it. And of course, if you have ever any issues with finding the data that's reliable to pull into this, that is where we come in. We have 50 agents in the GTA alone. That's part of our team that can help you analyze those numbers. But more importantly, across the entire country, we have 200 top 1 percentile agents that's called the REC referral family. And these are all people that perform real estate at the level we do. So if I were to send you to Vancouver, to Red Deer, Alberta, anywhere for that matter, Saskatchewan, if you're looking to invest in land or whatever the case, you are going to work with people who understand the product they're selling and how it can best be fitted into your portfolios. So just understand the scope of it, because this is not for Mississauga or for Toronto. This is for real estate, period. You can take this to Turkey, to Greece, anywhere. Fundamentals are the exact same. Without further ado, Bobby, why don't you tell us a little bit about the asset classes we're going to be looking at today?
So today we are going to look at, we've got a live deal in Beaverton, Ontario, a fiveplex.
And this is our listing.
This is our listing. So that matters to everybody online in the room, because we're the ones to verify these numbers very specifically. So one of our agents, he's actually in this room right now. That's Jesse in the back. This is Jesse's listing. He goes out and verifies each and every one of these things. So whether it's property tax rolls, rent rolls, all of those things, We can then insert that data into here. And the first thing that I would say to everybody as we do, this one is going to be a buy and hold. The next one will be a pre-construction, but a pro forma is only as ever good as the data that you're putting into it. So guessing at these numbers will not help you in any real way. It'll just give you this false sense of security that's going to push you into a deal that we weren't ever able to verify for you. Exactly. So that's why what he said just a moment ago matters so much. Working with an expert to get the data that you as a consumer or an investor don't necessarily have access to is paramount in this regard. So to answer your question, we've got a fiveplex in Beaverton today and a downtown Toronto condo to look at in the pre-construction space. We'll get to that one later, but let's start here. What do you say?
Yeah, I mean, this is I did the numbers on this with Jesse months before we actually listed it. We started gathering information. We started understanding the market, where the property is located. I think before you even look at a sheet, when looking at real estate, the opportunities come from understanding the tenant pool, which is your revenue. So just saying this property performs this way, for example, it's the cap rate, it says 6.3. That's a great cap rate. But that doesn't mean that it's a great property necessarily. It could mean a million different things. So the entire scope of due diligence starts with understanding the market itself. And I'm talking geographically, the local market itself. For me to give an opinion, an expert opinion on a property in Regina would be unlawful. I should never open my mouth on a property that I have no clue what the market around it is doing. It's irresponsible. That's why I know the first thing I said today is we have a referral network. Because at the end of this exercise today, I'm going to ask you, and I'll do it right now for the first time because there'll be many. Wherever you are, if you are looking at a deal right now, send us your numbers. Even if it's in an outside market, what we do to educate, what we do to help every single person is we have a dedicated team that can help you run your numbers. If it's in our market, God bless, we're doing a deal with you. But if it's not, God bless you, we're going to help you and hopefully save you from some big heartache and headache. Beaverton, Ontario is just north of Newmarket. It is along the 404, just off it. It's a market right outside of the GTA. First line of defense outside the GTA. Everybody in this room who is local from here knows that that is a great market. Those are great markets because north of Newmarket, you have Honda assembly plants, you have a massive industrial sector by Alliston, south of Barrie, and all around. You have beautiful lifestyle choices like lakes, rivers, forests, etc. You have great meaning the 404, the 407 series 15 minutes down the road, shopping, etc. You have everything within a 20-minute drive. Plus, of course, the town of Beaverton. The tenant pool is massive because there's so many employers. And right now I'm speaking to Beaverton, but I'm also speaking to St. Catharines, Hamilton, outside of Hamilton, Brantford, to the west. To the north, Alliston, Beaverton, Newmarket, that entire East Gwillimbury corridor, all the same. So there's your general geographic knowledge. We know that wherever you go in any of these markets, you're not secluded but from any type of lifestyle you choose, work you choose, car you drive, transportation choices. This is why all of the country wants to live here. When immigration comes in, this is why they come to the GTA. It provides that. So from a general perspective, we're winning. We're not fighting any forces outside of the scope of regular. We can hone in now down more. In Beaverton, what do we know about Beaverton? And the question is, if you ask me right now, what is the population of Beaverton? I don't know. What's the absorption rate in Beaverton? I don't know. I have to verify it. How many buildings just like this are listed in Beaverton? I don't know. But none of you know either. And if you didn't know to ask those questions, there's a problem. Because if I sell you this building and you don't know what the vacancy rate is, or the absorption rate for that matter, what if there's 400 other apartments that are vacant right now because something happened? Is there competition for these? Because it's zero vacancy. So I do know a couple of things. There's 1% vacancy in Beaverton because I prepared with this. But the point of the exercise is, what questions as an investor are you asking? Where is your mindset? Every dollar in your savings account you pay tax on. So when you spend 100,000, remember you worked almost 200K for that money. It's more important than you think. One mistake can flush you dry. And what we saw in 2020, 2021, 2022, we saw people accessing money that wasn't theirs, a lot of it, for very cheap, which, as it turns out, which nobody saw this coming, 12 consecutive interest rate hikes, but that money was not a gift. And everybody is struggling to figure out how they're going to catch up and make payments and do this, fix, adjust, and reposition. People who use this tool during that time, hundreds, maybe thousands actually of our, it is thousands of our clients. Yep. We do about 800 deals a year. So a couple thousand of our clients who bought real estate using this tool not only did not have a problem closing on their investments, we have 80% of them in cash flow positive zones, with the other less than 5% negative over $200 a month, and the vast majority right at the break even, with their valuations on their real estate up anywhere between 15 and 25%. So not only were they able to close because they bought smart, the incentives that were negotiated on their behalf is what carried them through what's the worst, actual worst market since the 1997, 1998.
That's what we were talking about the other day. Yeah.
So it's never been more volatile or dangerous, ever. And it continues to this day. But here we are, a room full of people here, and all of you online looking to learn. I still have a very, very busy job because real estate never sleeps. You go to sleep, real estate continues to work for you and keeps making you money while you sleep. But it's this pro forma here that's going to allow you to sleep, because a mistake here is going to keep you up at night for the rest of your days. Let's get to work on this. Let's go to the inputs. Stephen, if you want to show our people online, yeah, so they're going to be able to see.
Just sharing the screen now. Yes, sir.
Cool. Right on. So the property, if we're just starting at the top left, we're going to go here, and I'll guide you through, Bobby. So we're putting an offer in now. We're buying this property because we like it so much. Closing date's May 31st, next week. Our purchase price is $1.4 million. The acquisition cap rate, and I'll speak to what a cap rate is in a few minutes, is 6.3%. I'm going to show you guys how we come up with that number for those who don't know what a cap rate is and why it's a very, very important number. The closing costs in this case are about $30,000, and we are using an annual appreciation rate of 4%. Now, in the GTA, we haven't seen appreciation of 4% ever, probably in the last year and a half when the market was reshifting due to interest rates. But the average, the 40-year average in the GTA is just under 7%. We're using 4% because we can and we should. We don't need to count on the past to make a decision, but we need to know that if it does perform anything like it should, we're going to be double as good as we say we are. But using 7% and not 4%, now you're requiring to perform at a certain level because your assumptions were too generous. And this is, if we're looking for safety and shelter, our assumptions need to be the exact opposite of generous. They should be tight, laser tight. Okay?
Before we go any further, I would just mention to everybody, you're going to notice as you, like I'm highlighting this first column right here. So there's two different cell types inside of the proforma itself. Anything colored is manipulatable. Anything else, anything white is locked for calculation purposes. So when he was talking about a purchase price of 1.4 million, that's what we're entering. Okay? When he's talking about the acquisition cap rate here of 6.33%, right? That's being calculated based on other factors that are coming down the line. So I just want that process point to be known as you guys then start to poke around in the proforma itself.
Yeah, and give an example. So right now, if you just turn 1.4 into 1.1. Your cap rate hasn't changed.
Your cap rate hasn't changed.
Great. It just takes a second.
It does just take a moment.
Got it.
Right. So it jumped from 6.33% to 8.05% there.
So this allows you to save different versions and to do what's called sensitivity analysis. You can change your interest rates. You can change your purchase price. You can change your deposits. You can change the income of the property. And it's going to give you various different scenarios. This is the type of work that we do for a living. As an investor, this is the type of work you should be doing any given second you want to put into your investment practice. For all aspiring full-time investors, this is all you should be doing all day long, is analyzing deals and sourcing deals. So when something comes to market that's of interest, you run the numbers. This is running the numbers.
There are more inside of the proforma itself. There are more than 70 equations working at any particular time, all tethered in a way that we've been able to work out over the last 20 years.
Yeah.
I would actually say 40 years worth of experience, but this is where I like to say that Jazz doesn't have a computer. So that's 20 years of Simeon, 20 years of Jazz, but only Simeon's knowledge went in because Simeon has a computer, right? I'm kidding.
Because Jazz refuses.
Because no computer, right? But for real, the reason that cap rate didn't change instantaneously is because it runs through a module that is as many as 70 equations deep at any particular point.
Yeah, and these tabs here, so the version that we can give to you, and everybody will have a chance to get one. To the people watching right now, just hit us with an email at info@reccanada.com to request your pro forma and analyzers. Everybody here, obviously, do the same. It's info@reccanada, but we can also make sure that it gets to anybody who registered. It can be emailed as well.
Absolutely.
Going down the path here, so that was kind of our general stuff. All the tabs that you see here are the 70 plus things going on in the background that crunch everything and put it into these beautiful visuals that you're going to see in a second. This pro forma right here has the ability to take renovation assumptions into it, meaning that if you're acquiring this property, we're going to get each tenant out one by one. We're going to renovate to add value. You can add your renovation budget here. You're buying a semi-detached. It has a separate entrance, but no apartment downstairs. Well, if you need to burn 100,000 to create another $2,000 a month, it's exactly what you're going to do. That's why you're buying it. You put your renovation budget here. So let's add the renovation budget, please, Bobby. So we're going to spend 120,000. Starts in month 1, ends in month 6, and the after renovation value, or ARV, is going to be, in our opinion, this is now we're making stuff up because we don't know what we're spending. In this case, this specific property does not need a renovation. But if you wanted to do something to analyze, this is where you would add it. We're going to take that off again, only because this is an actual pro forma that I want people to see. And let's go down. Acquisition loan, 20%. It's residential, so it's 5 doors or less. You do not need commercial financing for this property. So this can work with 20% down without any acquisition fees. If it was a quasi-commercial or commercial loan, you would typically have fees of anywhere between 1% and 3%, or other fees depending on CMHC guidelines, etc. For those who don't know what CMHC is, it is the government-backed Bank of Canada for residential housing. And they have programs such as the MLI Select, which gives housing providers like ourselves specific guidelines. And if we hit those guidelines and those targets, we get rewarded with 50-year money at very low interest rates, meaning they are looking to get more investors into investing their money in multi-residential real estate. That is a little bit of a, not a little bit, it's a very different conversation when we're analyzing those opportunities, but very, very similar tools are being used for that too. So if you master this, it's very easy, once you understand the principles, to make the transition into bigger properties or more lucrative opportunities. Let's go down and talk about the revenue assumptions. Jesse, can you confirm that these are actuals? These are actuals? Great. So we're not working with pie in the sky numbers. These are actual numbers of 1845, 1850 per door. Stabilized rent only for renovation. Stabilized rent means, let's say rent today was at $1,300. After renovation, I could fetch $1,900. That's where I would put it. In this case, nothing is there because we're already at market. So this is a turnkey property performing at a 6+ cap that's on the market today. So this is a great property. Vacancy rate, we just put 1% to have something there. It's fully tenanted. A safe assumption to use across any market, any decent market in Canada, meaning any city. I'm not going to go into towns, but there's not many cities in Canada with vacancy above 2 or 3%. Most of them at 0 or negative, meaning people have to put multiples to find rental or pay more where the prices keep rising. Using 1% here is simply to highlight the area and put it in. Other income per unit per month, $40. Is that for laundry? Yeah. So this is a coin laundry operated building, meaning the building has a room where the 5 different tenants can take their clothes to get them clean using coin op laundry. And that averages clearly about $200 a month, which is 40 per unit. Property management fee is at 6%. 6% is typically very low for property management, but that is what the REC, that is what the REC insiders have access to using our very own property management company, which is RECPM, and it works with Marco Property Management here in Toronto. In other markets, there are referrals available. So to anybody online, check in with Tyler in our concierge. He can connect you, and you can expect between 6 and 8% when going through us. The market property management prices are starting now. I haven't seen anything under 10%, so they have gone up in price, plus leasing fees and other things. So we do have very good savings inside our houses because we negotiate for so many investors. So the property managers will fight and reduce their price to get our business. So just keep that in mind for all your portfolio, not properties that you buy through us. Annual expense growth, we're using the typical 2%. If we are in a high inflation zone like we are right now, you can make that a 3. It doesn't move the numbers that much. But what this does, this gives us, when we look at the next slide, you're going to see that this builds out an entire schematic, what he was referring to in those 70 calculations. This 3% of cumulative growth in your expenses is real. It's not fake. Every year prices go up, but every year rents go up as well. So if we were to just go back up 1 second, you're going to see annual revenue growth rate of 2.5%. Where did we pull that number from? Out of a hat? That is absolutely correct. Thank you, Claude. For those watching outside the province, Ontario is rent control mandated. For all properties built on or before October 31st, I believe, October 15th.
November 15th,
November
2018.
15th, 2018. I closed December.
Yeah.
No, I closed
You
October.
closed October. That's
October
right.
31st.
That's what it was.
So I was quite upset that year. I closed on a condo 2 weeks prior to the legislation, so I'm stuck with those rental mandates. But for any province, check your provincial regulations and mandates to see what you can use for your annual growth rate. Never, ever, ever do not serve your tenant with what is rightfully yours. Unless you are overcharging them and you feel guilty about it, is the only time that you should not raise your rent. The reason I say that is because this is a business. You're not doing a tenant a favor by letting them be there. They're not doing you a favor by being there. It is a trade done under willing circumstances that somebody's going to live and make their memories in your home. And for that, you get your income. So you can live out your memories as well. Every time I've ever heard of landlords, no, but they're great tenants, I don't want to lose them. If that's your only value proposition to your client, which is your tenant, you're doing other things wrong. And maybe we'll have a session to cover what that looks like.
Yeah.
What's important here is that we are taking into account our revenue growth. There are not many pro formas out there that have this option or thought of the option. So it's a static rent. So how do you know how it's going to be performing in 10 years if the rent's not going up and the expenses are not going up? Again, shooting in the dark. This helps shed light into the future. And if you use conservative numbers and real numbers, you're going to be pretty damn accurate. You'd be surprised how amazing it feels to be safe through one of the biggest disasters in Canadian history, which is the last 2 years. With that being said, let's take a look at some of the basic, and in this case, comprehensive expenses. Property management is 6%, annual expense growth of 3%. Property management fee turns out to be about $6,800, and that's a simple function of the total income at 6% gives you that number, or this much per month. Property taxes. So if I bought this property, I would never pay $1,300 for a fiveplex. I would probably bring this down to almost half. I would pay up for lease ups, but I would visit the property, etc. But leave it as it is for somebody who's a passive investor. Property taxes are what they are. Insurance is what it is. General payroll, general administrative, marketing. These would be populated if you're going to rent it out. So think Kijiji ads, Facebook ads, Google, Housebuster, all the different things. General and administrative. If you're buying this under a corp, you're going to have to file taxes for that corp. You have to put your accounting fees in there. If you needed an appraisal, if you had a groundskeeper, a snow contract, a summer contract for lawns, that's where this goes. So based on how you operate your portfolio, should you buy this property, you need to fit these in because there's no general outline. Everyone's different. So with that being said, utilities, again, these are real measures based on actual bills from the property, repairs and maintenance, and contract services. So that's how you sort through that. And I want you to take everyone through the overview because this is the fun part.
Yeah, I suppose so, right? So everything you've just entered on the inputs side of this thing is going to flow through one of those bottom tabs and appear out on the overview page. So you've got one central place to be looking at the performance of this particular property, any property that you're putting in. So you would notice immediately from the top left, moving forward, 5 units were entered on the other side. 5 units are now here. Your purchase price and your acquisition cap rates are all here. A purchase price per unit is simple functionaries that are pushing through to this side. Okay. This is now going to give you this middle portion here as well, where total sources of capital required, acquisition loan proceeds, things of that nature, plus your purchase price, closing costs, all of those things, all added up into one spot so you understand the funds required for acquisition. Remember we clicked on and off the renovation portion earlier. No renovation comes over because we clicked it back off.
So what this would have done, if we just go back there.
Yep.
So start month, it was month 1 to 6. Total construction costs, call it 100,000 just for fun.
Sorry, here.
No worries. Perfect. Here we go. So month 1 to 6, 120,000 total costs. Total cost per unit, 24,000. This is very typical here, guys, because in these units, all we typically do is go in, paint, maybe do floors, bathroom and kitchen, like an IKEA kitchen, 5-10 grand, washroom, 5 grand, a paint, and you're back in brand new business. So 25 to 30 grand a door on these small buildings is quite typical. If you don't get into capital expenditures, such as heaters, roofs, building systems. So this is typical. Return on cost. The reason it's 92% negative is because we never put the upside.
Exactly.
So if we go back to input,
that would have sat right here in that stabilized rent.
let's take a look at that.
Only for renovation. So if I was to
2,200.
update that, you read my mind. That's wild.
We spent a little bit too much time together.
Yeah, I think so. Oops. And we pushed back through. I would have actually just called your attention to return on investment in the bottom left-hand side. That graph was inverted, right? It's probably in the worst place for everybody in this room to see it, but it was inverted in the moment and is now not. That number in the top left-hand side has jumped from a negative 95-ish% to the return on cost of those renovations of a positive 17.5%.
And what this tells you guys is you spend 120,000 of net dollars. This return of 17, or let's call it 18%, where does this number come from? What does that represent? You have 5 units that went from 1875 to 2200. So it's 325 per door per month. 3,600 annually per door. Times 5, 15 or 18,000, whatever it is. 18,120 is 18%. It generated the $120,000 you spent, generated $3,500 per door per year. 5 units, call it 18 grand, whatever it is. I'm just doing quick math. But if anybody's wondering where did that number come from, this pro forma gives you that. It gives you the opportunity to take a look at real numbers. If I spend this much, how much exactly am I making? And it should not be done by somebody like me telling you in 5 minutes. It should be something that you spend 2 hours on at home looking at, making sure that it's through your head.
And I would interject right there just ever so quickly. I think a huge mistake that investors make is say, well, I'm going to put X number of dollars in a paint, quick reno of the bathroom and the kitchen, and that's going to get me $350 more a month. Right? When you're working with a team like the RC Canada team, we can send Jesse out into the marketplace and find comparables like that. So we know within a 10% margin of error at any particular point what that renovation should return to you. We're just going to find units that are similar to that, or we're going to reset the market to those things
that are renovated
based on our expertise in this realm. It's the biggest mistake I used to make as an investor. If I do this, I'll get that assumptive, right? Use the team to do this proof every single time, every time.
So somebody has to prove it to you. So if I were to say there's upside here, Claude, there's upside here, I want you to buy this, there's upside. You need to say, prove it to me. What do you mean there's upside? Well, if we renovate, we're going to get $400 a month more. Prove it to me. Show me the unrenovated unit, how much it fetches. Show me the renovated unit, how much it fetches. You're going to come back. I'm going to come back to Claude. I'm going to say, this is 1875. This is 2200. Prove to me how much I need to spend. Because you just said it's 30,000 a door. Has anybody looked at it? Can we go in there and rip a kitchen out without having to fix everything else in the building? How many nightmares have you heard about that? Where you open the wall and everything's crumbling. And now they're in a financial disaster. Why? Because they never got an inspector. A building condition report. Everything has to be proven when you're investing in real estate. Because after you buy the building, the only other option than success is failure. There's no halfway. You can either cover your bills and succeed, or you're going to meet your financial ruin anytime. The numbers are too big. So you need confidence to succeed in this market and knowledge. This tool gives you control of every single decision you make. And that is our only goal and objective, is empowered investors that will call us for the data they require to get it done. And if it's not us, one of our partners all over the country. But you will be making housing affordable and perfect for Canadians. You are contributing to the solution as investors, not to the problem. Let's go down some of these metrics here, because it's how they will measure their success from a monetary standpoint anyways.
For sure. So from left to right, return on investment, that's an ROI calculation, ROI, return on investment, utilizing your cash flow, your principal reduction, and both sets of appreciation. In this particular case, there was no, we call it forced or active appreciation. There was no renovation done. This is a simple acquire to continue with, a buy and hold. Okay. The other one would be what the market is doing. So you remember on the other side of this that we used right in the very beginning, 4%, not just south of 7%. That's where these numbers are all coming together. That is all divided by your capital invested. If I went back to the top of this screen, that total uses number that you're seeing right there in the middle, right here, okay, is what we're utilizing in order to get to that particular number. No need to take pictures. We're going to give this to you. You're wild. You're wild.
You take pictures, my friend.
All day long.
You take.
Yeah. Oh, awesome. Simeon. Oh, wow. Oh,
wow. Let's do it.
As we move across from the left to the right, the property price appreciation is exactly what I just mentioned. That's your purchase price, okay, and what the market is doing to it over time. It's relatively steady growth. Okay. The loan and principal reduction, some of you may have heard that as principal recapture or mortgage pay down. That's exactly what that is. That is the P of the P&I, the principal portion of your mortgage, the most stable portion of the return across the board. And then the cash flow component as well, off to the right-hand side. That is any dollar left over after all expenses. Sort of the cherry on your sundae, the gravy on your poutine, right? I'm just a food guy. I'm sorry about
delicious.
That. Delicious. It was delicious. Those are visual formats of that, but now we can also break this down into the actual numbers, the dollars and cents of the matter. And what we've done is that we believe, we have a pretty strong tenet here at REC Canada, we believe that property prices will effectively double every decade. So we want to be able to show that and why we believe that thesis in a 10-year extrapolation of what these numbers can and should be moving forward. So all of those numbers that we've worked to enter run through land transfer tax modeling, through inflation modeling. All of the things that we spoke about on the other input side of the page are now here for you to be able to rip through from an income and expense component.
Is it okay if I add something, Bobby?
Of course, please.
Bobby mentioned that we aim to see the market double every 10 years. We don't aim for anything of that nature in the GTA. And I'm talking from Bowmanville to the east, Hamilton to the west, Barrie to the north. Every 10 years for the last 40 years, 4 times 10 years, and I'm not saying this to be funny. If we go back in time right now to 2014, to 2004, to 1994, to 1984, I invite every single person watching to visit Canada Mortgage Housing Corporation's website or the Toronto the Toronto Regional Real Estate Board's website. These are government websites that publish real data from the market, and look at the prices of homes in 2024. Pick the same asset, any asset class for that matter, it doesn't matter. Go back to 2014, to 2004, to 94, to 84. The only pattern you're going to see is a doubling of prices every single decade. 2004 is when I bought my first property. I was 24. 2014, I was already 3 or 4 properties deep. I was 34. And you've guessed it, I'm 44 years old right now. We have just over a dozen properties, and we've bought them throughout many different timelines. Myself and my business partner, Jazz. Myself and a few other joint venture partners. But we have quite a bit of property that we've bought at different timelines, Each one of them have different returns. But the market here in Ontario's Golden Horseshoe has doubled every 10 years for real. If we were to look at Vancouver, I would imagine it's strikingly similar or even outperforms the GTA because it is Canada's most exclusive real estate, meaning there is nowhere to go. It's full. It's full. Mountain behind them, ocean in front of them, nowhere to go. So the density that keeps coming keeps pushing the prices up. What I can all but guarantee every single person watching is that the number that I use, the 4% for appreciation, will be wrong in the way to make me look like a hero. Because I am still a real estate investor. My personal, not my business opinion, is that the market will grow very quickly post 2026. The last 2 years have stopped all construction. If you guys take a look in Google housing starts, you're going to see that it's a critical and emergency matter in Canada, but financing does not allow builders to build. So the minute over the next 2 years that the housing that's available right now that cannot sell because it makes no sense at 7% interest, once that inventory is absorbed, prices are going to skyrocket because people are still coming to Canada. They have changed nothing. So we are going to be tremendous benefactors of our government's inability to get it right. And that's why it is a great time to buy real estate in Canada. You just have to be well qualified and very, very diligent about it. What these performers also do is they lead your thinking to creative deal structuring. We put, can we go to the input page for 1 second?
Of course.
And this is an example. If we go to the acquisition loan, and there's 20% of purchase price at 5%, right?
Yep.
What if that was 3%? What do you think the numbers look like if we get this thing at 3%? Who here thinks it's possible to get it at 3%? Well, not from a bank, you can't get it for 3%. Nope, doesn't qualify for CMHC. Where else could we get money? Private lenders are gonna require more interest than the bank. Where could we get money for up to 80% loan to value to acquire a property if the bank doesn't want to lend us money? Private lenders cost more than 5%. A HELOC against a different property, perhaps. It's an option. Like who? Go ahead. Nope, it's been said. Who said the owner? Seller take back financing, vendor take back financing, owner finance. There's a million names for it. What if this guy wants 1.4 million for his property, but right now because money at 6% makes it cash flow negative, he can't sell it? What if he needs to sell it because he needs $400,000 out right now? What do we know about anyone? Nothing. Why do you assume you can't ask the question? This calculator allows you to look at things differently. You can call your agent and say, Jesse, I want to make an offer on this building, but I can't do this at 5%. It doesn't pencil. It doesn't work. But I really like the property and I know where things are going. I want to offer $1.3 million and I want 50% of it as a vendor take back at 1% for 2 years. I'm going to put 20% out of my own money, and I'm going to get 30% from the bank, from a private lender, from this, from that, from the other. I'm not telling you a real scenario. I'm telling you that you as an investor have unlimited options. There is no one way of writing any one deal. But you will never know what those realities look like if you don't have a tool like this. How could you figure that out on your own? You could not, because there's too many components to it. But when you bridge the gaps between different strategies in different money models, you actually end up with something that is useful for you to make your acquisitions happen. Claude, do you have a question? Oh, sorry. So just going back here, give me a little bit of the actual ROI, and if you just go down a little bit more.
I made some changes as you were talking.
Great.
To your 1.3 at 3%.
Sure.
So let's just remove those and get it back to what we had started with.
Yep.
And there you are, sir.
So yeah, to just conclude on buy and hold, because I do want to present also another asset class, which is pre-construction, which a lot of REC insiders do or have done. So you get to learn how to use that. What would you say in closing for the buy and hold? Is there something specifically that you focus on when you're doing your analysis? Is there a tip?
No, listen, in the buy and hold scenario here, I'm always looking at ensuring that these numbers are correct so that I understand what sort of cash flow component is going to come. I think it boils down to cash flow being king. Everybody kind of hears that. It isn't always king, but in a scenario like this, it's exactly what we're going to need in order to ensure that this is going to work for us. So I would focus on that line item a little bit there. Cash on cash is something that we should probably touch on, so that your cash is going to perform in cash back to you. So that's definitely something that we're taking a look at. Okay. And then, sorry, go ahead.
Should we perhaps define cap rate, cash on cash, return on equity?
Let's do it quickly.
Sure. So the return metrics that you see there, and I encourage everyone to actually take 10 minutes to Google it, to read the definitions themselves. And that will also provide you the formula for it. But just so we're all kind of streamlined in our thinking today, a cap rate is made up of two numbers: the net operating income of any one given property. So they get $2,000 a month in rent per door, minus the property taxes, all the expenses, we come up with the net. Call it $100,000. $100,000 divided by the purchase price. You will only have one cap rate. One when you buy it, one when you sell it. If you understand some multifamily, any investing, your acquisition cap rate being 6.22, every year that passes, every year that the income goes up, the cap rate's going up with it. Every time you renovate and it's worth more, cap rate goes up. But when you sell, as a seller, you're looking to do the exact opposite you're looking to do when you're coming in. You want to sell to someone at the lowest cap rate possible. You want them to pay more for your property to make less money. And that is called cap compression. A value-add investor takes an underperforming asset, fixes it up, and sells it for more. All the industry jargon I was just using, cap compression, etc. Some of you may understand it. For those who don't, you're spending as little money as possible to sell it for as much as possible.
Yeah, who's heard the old adage, you make your money on the purchase, on the buy? That's this in mathematical format.
Because people have a tough time with that one.
100%.
People say, what do you mean you make your money when you buy? It's when you buy, because you can never change that. So if you paid too much, if you paid too little, if you paid all the things in between, you will never change your acquisition cap rate. But you can control your exiting, your disposition, your selling cap rate. And that's the magic. That's how we make hundreds or millions of dollars in real estate, is by making these plays. So cap rate is very important. That's NOI, net operating income, over purchase price. Cash on cash. That is as simple as we need $300,000 to buy this property. That's our cash. It includes closing costs. It includes everything. One hand, we have $300,000. The other hand, we have the annual net revenue, that net operating income. Net operating income over your cash invested gives you your cash on cash return. In this case, it's 5.3%. Is that Jaden clapping? Yeah. I'm a huge fan too. Thanks, Jaden. I appreciate it. Everybody was waiting for that one. It's a golden nugget. So going back to cash on cash, it's very simple. It's something that you always have to gauge. Cash on cash, well, it's important typically for the first few years, as once you know your cash on cash return, it doesn't become a very important metric. It's important on acquisition because you need to know if you can service your debt. So that's more of a cash flow measure. So sometimes you got to put in more cash to make a deal work, but it brings your return down. So an underperforming asset, that's key. When cash on cash is low, there's a reason. So it's important in the beginning. It fades away over time. Return on equity is a big one. And this is very underused. The return on equity, the longer we own a property, the more equity it has, the lower the number gets, or it should. Yeah. Yep. So in any case scenario, return on equity, your return on equity, it is your cash that you use, that $300,000. Okay. Every year, the price of the property is going up. So when you put your cash versus the equity available at any given year in the timeline, as this grows down further, that means it's time to refinance. This is a very important metric of gauging how much, where opportunity can come out of. The reason you've heard people say, my ATM right now is my fiveplex in Niagara. I'm going to get my money from here, from there. You don't ever have to refinance your property. You want to own the mortgage free, you do that. All the power to you. But your return on equity is zero. And that is a missed opportunity. It is safe, it is conservative to have tons of equity in your properties. But if you're a growth-oriented investor, it is not prudent. You should always have a balanced approach of debt and equity so you can continue to grow. Now, if you're 65 years old and you don't want to grow anymore, you just want to service, keep, and maintain, no problem. That's a different strategy altogether. But this metric, return on equity, the lower the number, the more opportunity the property has to fuel the rest of your portfolio. That's what I use this for. The higher that number, the tighter the margins. So just know how to use them. And if you have more questions, Google is your best friend, but Tyler at My Concierge is a better friend. So he'll actually put it into context and teach you how to use it. Let's go to the other one, the other pro forma.
You got it.
Anybody have any questions as we leave buy and hold? Yeah, sure.
I just wanted to make a comment. Let's say you didn't use that $300,000 cash, you actually had it financed. You've only put in 20% out of that 300. 20% down out of that 300. So that number that you presented is actually much bigger opportunity.
Well, it depends on how you finance it.
Exactly right.
So can you repeat your question, and then I'll repeat it for the audience.
So you had it that you used 300 of your cash.
Yep.
To buy that fiveplex, and then now it's a missed opportunity because there's equity sitting in that property and you haven't leveraged it, right? That was your comment. So in response to that, what I'm saying is that if you didn't use that 300,000 cash and you only used 20%, that missed opportunity is even bigger.
For sure. So I think the question lies to the ability to use other people's money, for example, for a deposit. Is that where you're going with it? Not using your own capital? Or am I misunderstanding it?
Maybe a little bit of that, but I think more along the lines of if you weren't going to use the stored equity over time, there seems to be a greater potential like pitfall or loss to that than continuing on leaving all of that money stored in one place. Do I have it correct-ish? Right? So like there's a really easy way. I like the simplistic way of things, right? That's why I said like, what was the thing before? You make your money on the buy. It's something that people get. In retirement here in this country, you can't eat a brick. Okay? If you're going to leverage that property to the hilt here to 80% loan to value, again, maximize what that equity is, right? You've just washed away, in theory, as much of the cash flow as possible in order to do that. So you have to understand as an investor where you go and why at each particular point. There's an argument for all of this, right? But at 65, if I stopped working using that number as one would, okay, and I had $0 in cash flow, I've just eliminated my income. But what I have done is taken all of those dollars tax-free, in theory, to myself and put it in my pocket, which is better for you in that particular moment. And I think that there's a huge middle ground to that. I think that some people are going to leverage $200,000, $300,000, $400,000 off of a property like what we just showed you, and maintain cash flow of $24,000 a year, $2,000 a month, in order to maintain the lifestyle that they want. And the real beauty of real estate is that it's never actually a missed opportunity if given enough amount of time, because that will regenerate to a higher cash flow number, right? You're still going to have that principal pay down component years and years after that initial refinance. And done long enough, long-term enough, like over the course of a lifetime, there are a million opportunities to do any one of those two things. So always keeping in mind, sure, it may feel like a missed opportunity here, right? But it could be the right opportunity farther down the road, and vice versa. Okay? Make sense?
You just brought out one of my favorite hacks.
Hacks.
It's kind of like cheating the system for yourself. Not trademarked.
Right.
If you're 65 years old and you own a couple of properties free and clear, many Canadians do.
Yeah, many.
And I'm talking many, because 50% of Canadians don't have a mortgage. Actually. If you're 65, you don't have a lot of money in your bank account, you have a couple of properties, you have your RSPs, you have your things. Property's worth $800,000. Call your bank, get $400,000 the day before you retire. You're still working, you take out $400,000 and you put it in your account. The property's only loan to value 50%. The payment is, I don't care what it is. Doesn't matter. Do we pay taxes on that money, Bobby?
We do not.
We did not, because it's a refinance. We're actually writing off the interest on top of it, because it's an income property that's rented. So the tenant continues to pay the rent. You top it up if it doesn't cover it with your money in your account. And you got $400,000 to spend. Call it 150 of that will service the debt for the next 5 years. Is 40, 50 grand a year from one property not enough spending money when you're not working and you just want to relax? Do it to a couple of properties, it's double that. But the reason I didn't tell you to sell it is because for the next 5 years, that property is still appreciating. So if it's worth 800,000 today that we took it, and it's worth $1 million, just $1 million, mild appreciation in 5 years from now, we actually made up half the money by not selling it.
Yeah, by simply letting the market do its job.
And you servicing its debt with the bank's money. People don't think of the incredible options that are sitting right in front of them. Selling your existing real estate, I know it sounds weird coming from an agent, because I win when you sell. But I would rather you buy more real estate. I win then too. But keep your real estate. Because it will continue to pay you and pay you and pay you.
Yeah, like everyone, even use the example that he just used right there. And he said, and the market's going to appreciate over that next 5-year period as you're paying yourself with the money that you refinanced 5 years previous. What if the market didn't do anything? What if the market stayed stagnant at zero, which we've never actually seen over a 5-year period? But let's assume in the worst case scenario that happens.
But you can run that on a pro forma too.
You could run on a pro forma. Okay? But the point I'm going to make is that, sure, it's worth $800,000 5 years from now. And it was an income generating property when you refinanced it. So having those tenants in there working towards an income on that particular property actually just serves the most stable portion of your investment, which is the principal pay down component of the mortgage itself. So sure, you might be a little bit behind what you expected to be, but you're still carrying the entire thing and actually making money in the most stable possible sense of the words. It doesn't have to appreciate for you to win. It just tends to do so. When done correctly with metrics, you simply win.
In every level, with mortgage pay down, with appreciation, with everything else. Anyways, we're making a great case for real estate. We might have a bias, you think?
You think. One would imagine.
All right. So let's take a look at asset class pre-construction. What time is it?
Oh, we've gone so long. We're already an hour in.
All right. Let's do this one a bit quicker. Is everybody okay for time in here? For those at home, if you have to go, say la vie. Take a look at the recording later for everybody here. Of course, our recording is going to be shared with the entire REC Insider community. Go ahead, Bobby.
From the pre-construction sense, we believe that it breaks down into two distinct phases. Acquisition phase, that would be you placing deposits over a long-ish period of time, depends upon the project that's been chosen. And it works towards then when you're going to take occupancy, but most specifically, in our province at least, registration. Registration is the tipping point into the buy and hold phase, which is where everybody will always tell you that pre-construction is a speculative investment. And that only encompasses a portion of what the investment class is meant to do. That would be that acquisition component. The buy and hold phase is the part that everybody forgets, that you still have an asset come closing time that can then be rented for a potential income. So the pro forma itself is built out in that way. The top portion here that I'm showing right now, and I'm not actually sharing my screen, I stopped the share. So for everybody at home, just give me 1 second, I apologize. Pre-construction, pro forma, and there we go. Apologies for that. The first input component is going to be your acquisition phase.
And Bobby, this is the Greywood product?
This is a live deal at Jack Condos in downtown. It's right near Metropolitan TMC. That's the name.
This is Greywood. We met with them last week. They pitched us on their remaining inventory. If anybody is looking for any type of inventory or wants to see the state of the market downtown, this would be actually live.
This is literally live. I built this morning when I couldn't sleep. I was so excited about it. Everybody laughing.
Hey, and that was a lie.
The stress. Okay. But what this pro forma is built, it's built the exact same as the other one. So any colored cell you're going to enter into, any white cell or not fillable cell, right, is obviously locked for calculation purposes. So what this has allowed me to do is say that I'm going to sign on this deal today, and here are the deposits that are expected of me. $5,000 with the deal, 5% in 30 days. The math works within the pro forma itself. You would notice that $45,000 isn't 5% of $1 million. It takes into account that initial deposit component. In 204 days, which is, I used my mother's birthday actually, December 15th as your next draw of 10%. And then in 400 days, sometime right around this time next year, is when you are meant to go to registration, when that last 5% is going to be required.
So you have a year headway.
You have a year headway. Now, remember, most of the time in the pre-construction world, we're talking about two very distinct times to buy. Right at the very beginning, and what we would sort of deem that launch or platinum phase, where you're going to get the lowest possible price you're ever seeing, because they're simply going to take these things over a 4-year period and raise prices strategically over time, they being the builder, developer, marketing agency involved. This, though, is closer to the end of that 4-year period that it took them to build. And this is when they get stuck. They, the builder, the developer, the marketing agency, they get stuck with some things that they don't necessarily want to keep on their books anymore. They're in the game of registering the buildings themselves. Registering means that now you and you and you and you as buyers have taken it on for yourself. These are your units. They come off of the developer's books. They make their profit then. So they want to move these things. And sometimes, like in this case, a 3-bed den and a media room is very difficult to move based on price point, desirability, things of that nature. But when we identify something like this, a 3-bed within proximity to the old Ryerson University, TMC, I believe it's called now. Did I get that right?
The Toronto Metropolitan
TMU. When we look at this, there's the potential here for this to be a student rental and a very high-end one at that. Lots of space, a bit of a premium to the students looking to go there, and they can pool dollars. Okay? So that's why we identified this one as a potential for something that we should be analyzing.
Listen, downtown Toronto has been, and will be blue chip investment real estate. It's in proximity to everything. Every building is in proximity to everything.
Yeah.
It is a global city at last. It has the infrastructure and continues to grow in infrastructure. An entire new subway line is headed to Scarborough that goes through the downtown East Core all the way up East York into Scarborough, connecting it even further. The density is insane. Prices, this market right now makes Toronto very difficult to invest in because you require a lot of skill and negotiation, which is what we do. If you were to just go buy this right now, you'd be upside down $2,500 a month. Doesn't work. The way we craft deals based on what Bobby's going to show you right now can make this cash flow positive. Don't allow the newspapers, don't allow your barber to tell you what a real estate investment should look like. Just like I don't ask Stephen Rochester for advice on my heart health. I ask my doctor for that. Speak to a trained professional, an accountant, your realtor who's investment focused, your lawyer who's investment focused. How do I structure a deal to work? If they tell you how and it works, because we're going to show you how it works, the only thing we haven't done yet is go back to them and show them this, because they're going to get upset. Do you want us to sell your condos downtown Toronto, Mr. Graywood, the developer? They're going to say yes. This is the only way we can sell it. You have to give us this, this, and this. They have a choice. They can say, no, please step outside my office. Or they can say, how many can you do this way? And that's where you guys win. Because you're going to see every metric that a pre-construction unit has, where the risk inherently lies in a forward-facing investment, get mitigated completely down to zero. Go ahead.
So that brings us to the buy and hold phase component of this particular investment. Again, any of the colored cells, right, are editable. So the ones that I would call your attention to here are rent per square foot, $6.25. That's going to feel high to people from a square footage perspective. The math goes out the door, 3-bedroom renting at $66.75. And we actually had someone else in the room this morning, Cheyenne, pull a bunch of comparables to this. And he found comparables all the way from, this is insane to me, but from $2,500 a month for a 3-bed downtown like this.
$3,500.
$3,500 to, I said it wrong, $3,500, right? But $7,000 on the high end, okay? So we don't want to be shooting at the high end, but there's a reason that we can put this number here. And the reason is that Graywood has a rental top-up program, almost a rental guarantee, that is going to allow us to get to this number regardless of what we can actually go to the market with. The example here is that if I go outbound and I get a $4,500 in rent, which is completely average, okay, their top-up program takes me to $2,500 more than that. That's their guarantee to us contractually. So that allows us to then put this number in here and still be relatively conservative. That time frame ran 22 months on their program. So now we actually have exit strategies built within the system itself to be able to say, if I disposed of this 22 months after my registration, there's a chance here that I've made all of my money back. You'll see this on the other slide in a moment, but I've only ever done what the market has asked me to do as well. So that's why we're able to build that particular thing in there in this case. Not every program is going to be built the same. This one just happens to be this way in this moment.
we also recognize that we live this reality every day, and we have a very obvious, clear understanding of how this works. If this is confusing to anyone, if right now you're standing there saying, like, what is he like? Where does he tie that in? We understand that because I've been told that many times. That although you are saying it, you understand it, Simeon, I still don't. If you feel that way, I beg you for yourself to just email us saying, give me a one-on-one for a half hour. It's what I do for a living. You're not taking up my time. We ask that you respect us by allowing us to teach you how to do this.
Correct.
Because every time you succeed, we win with you. We have vested interest in your success.
Yeah.
So if anybody has questions, anybody from anywhere in Canada has questions, please reach out to info@REC Canada, and we will take you through the exercise with absolute pleasure.
You can also go to, this is a shout out real quickly to reccanada.com/brunchrec, all one word. It's where everybody would have registered to get the link today, all of those things. If you scroll down that page just a little bit more, you're going to book in that 30 minutes with Tyler under the Real Estate Action Plan, REAP. You can just do this yourselves too. info@reccanada.com, reccanada.com/brunchrec. Either works. Moving forward into, you've got the same ability in this pro forma here to be able to do your operating expenses as well. You'll notice down the bottom, there's OPEX inflation rate. That is your, excuse me, operating expenses working with inflation again, increasing over time. Okay. In this particular one, the land transfer tax is something that we need to be able to call out. There are intricacies across this country. This modeling that we've done allows me to go anywhere in the country. So I don't know if you can see it real well in the room, but on the television screen at home, on your computer screen, this should show up as British Columbia, Alberta, Saskatchewan. This sheet itself has all of those intricacies built right into it. You're simply going to select where you are, where the property is. Okay, select the jurisdiction that the property is in, and it's going to spit out the correct land transfer and GST, HST components for you. As you move downwardly, move out of that, you're going to see this red number right here, $75,000 adjustment. And this is another intricacy of this particular deal. So the Greywood properties, right, they want this to go, and they're willing to add $100,000 based on their sheets, everything that they presented to us, to your closing costs as a credit on closing. So there are some unknowns when it comes to this. We don't know how that's applied. We don't know if it's cash to you, if it's a credit and you're going to have to come up with the cash. There's a couple of things that we definitely need to go back upon. But when we go to run these numbers, you'll notice that I didn't do $100,000. I did 75. And we're just trying to be clear about.
Well, we also took $100,000 off their purchase price.
That's why they would be upset. You mentioned that before.
So this pro forma is real to what they offered to us, except that I took $100K off their purchase price.
So Alan, if you're watching, we're coming for you. Okay.
No, really though.
But you would notice here then that what we're attempting to do is that their claim to us is that we're going to cover all of your closing costs and we're going to cover you through occupancy as well. Occupancy is the period in Ontario between you taking actual occupancy. It's fit for human living. So you're going to be able to place a tenant there during that point, but you don't have any debt yet. The mortgage doesn't come until you actually register. So they're actually willing to carry you through that entire point, which is there's nowhere in this sheet for us to be able to do that. It's very unique to this particular deal, which is why we've manipulated the numbers the way that we have. But what you'll see on the other side of this thing, okay, is again the same structural pro forma type data that we were hoping to be able to push out when we first built this. So a yearly return on investment and a cumulative return over the first 4 years of this particular purchase. The property price at the end of 4 years. And there is a bit of a glitch in my particular sheet right now. Normally I can flip these to show you years 1 through 10 in these big bold slides there. It wasn't. If I go click 5, I don't think it flips to 5. Yeah.
Got it.
Yeah.
Sorry.
So I'll go home and fix this. But same idea, everybody. Very rarely are we going to see something that grows in such a linear fashion.
And what did you use for appreciation here?
Appreciation, I would flip back to, and I believe No, property appreciation would have been in the top component. Annual appreciation rate of 4.5%.
And that's in downtown Toronto. It's much higher than the 40-year average of 7. We've had freak years because of the amount of growth in immigration. I don't want to appoint higher. So 4.5 is a very safe assumption for downtown Toronto. Feel free when you're playing with these tools to bring it down to see how it does if we do go into a slow market. But there is absolute evidence to the contrary. So I think you would just be doing yourself a disservice by lowering numbers further than that. But feel free to do so. Anytime you start really testing the pro forma in different metrics for different scenarios, it's called a sensitivity analysis. What happens if appreciation goes down, if interest goes up, if this goes up and down and sideways? You see different scenarios that could affect you and how. So play with it. That's what it's been meant and created for.
I would call out 2 things ever so quickly. The first is that this goes from a lighter gray to a darker gray. That line, okay, is literally a line in the sand where registration happens. So if this was a more traditional buy at the launch phase and it was going to be 4 years worth of deposits, that line would shift to somewhere in between years 4 and 5. So you would understand exactly where you then begin to enter that buy and hold versus acquisition phase component. The second part would be normally in these years right here, you're going to see a much, much higher rate. Can anybody tell me why? Years 1 through normally 2, 3, and 4. Okay. Anybody want to take a stab at it? This is a truncated version of pre-construction. You've only got a year until occupancy registration. Normally it's much, much longer. So you don't take on any debts, no real payments until farther down the line.
And no revenue either.
No revenue either, okay? But what inevitably happens is that we commonly are able to negotiate things like 5% down in year 1, year 2, year 3, year 4 is going to come all your closing costs. So you see that drop just a little bit, but the market is going to pace with it at something like 5% this year, 5% next year. And if those were a 1-for-1 scenario, that would actually be 100% on your money. So you're going to see quite a jump in those years. And that's that speculative nature of what the acquisition phase can be. And we simply don't know. So we estimate as low as possible based on realistic numbers. You're going to get to that buy and hold phase. You're then going to start to see all of the other components jump into it. That's cash flow, principal recapture. Okay. All of those things are going to hit there, which actually is better suited to show you right here. This is a yearly ROI chart, jumping from annum to annum, individualized. Again, inclusive of your property price appreciation, net cash flow, any deposit interest, where your GST and HST rebates come and go. All of that is encompassed within here. And to break it down even further into each one of those components, we've got the sources of your return here as well.
And we are cash flow positive from the commencement.
From day one.
Yeah.
So anybody that's willing to tell me that cash flow is impossible in the city of Toronto, you're simply wrong. You can find it. You have to build it. We have to build it and present it to you. But it is doable, and it's doable to a very lucrative degree when done correctly. Okay?
Like any other deal.
The best deal you're ever going to do is the one you create every time. You've got a property performance metric, and you've also got your going in annual operating expenses. Going in actually triggers at year 1 of buy and hold phase. So this is a quick overview of what your yearly operating expenses should look like.
Yeah.
Okay. And here, everybody, once again, is that 10-year pro forma that we are going to be able to project to a degree, and moving forward with all of those conservative numbers that we just showed you. So 2 things that I think I would tell you right now. This is a live deal. You could have it today if you thought you wanted it today. It's not a sales pitch, because the second thing that I would tell you is that we need to go back to Greywood and tell them this can work for our investors if this
Yeah, you actually
happens.
don't have this deal.
Right? We have a deal.
We have it. We have a deal that doesn't work, but we have the solution to making it work and making it profitable. So if anybody wants to be a guinea pig and tie up a property for 10 days, doesn't cost you anything, but you can actually see how a deal is created. So if anybody's looking to put through themselves through an exercise, you can do it and see for yourself proof that you can create a deal anywhere with anyone. People simply don't understand that you don't ask, you don't get.
And I think that this is a very interesting time because I don't like when things come in twos. I want to tell you three things. And the third thing here is that for the first time in a long, long time, builders need you more than anything. And they're willing to work with you. When we sat down, and the reason that I would actually say that this is a doable deal right now is that when we sat down, I mentioned Alan before. Alan's a great guy from Greywood. Love him. He said, bring an offer. And that's the first time in my 7, 8, 10 years being around you that I've heard a developer say that.
Well, it's the first time they've ever been so exposed. Builders have vested hundreds of millions and they got hung by interest rates. They have to finish. We're so lucky to be working with the most solid and well-capitalized ones.
Yes.
But that doesn't mean they like getting hurt just because they can afford to. That just means they're not going bankrupt. People want to move their inventory and investors are cashing in on that need.
Exactly.
So whoever has the capital to invest, this is the time to really put it to work where you can leverage the hurt in the market to your advantage. So
just a couple of more anecdotal things. We were sitting with another company a couple of weeks ago. There were 70 starts in the city of Toronto last year. 7
project starts, developments,
starts.
like high-rise buildings.
Okay.
70.
70. Okay, 7 met their construction financing needs. So 90% of them won't build on time, if at all. And then it goes back to something, it harkens back to what he said earlier in our presentation today. It's that come 2026, there's going to be a crunch on the supply, a greater crunch than there already is.
Yeah.
If 90% of builders can't build on time, anecdotally, and we get to 2026 and there's now an even greater crunch on supply, what is economics 101? Supply, demand. As an investor, what side of that do you want to be on? You need to own more portions of the supply.
Of existing at that time.
Existing at that time in order to meet the demand that is going to inevitably come. Everybody asks me every single day, is now a good time to buy? The only answer to that is yes. Make sense?
I think that concludes our presentation today, my man. I want to thank everybody. A big round of applause to you guys for supporting us and being an amazing live audience. To everybody at home, thank you for spending your glorious Saturday morning with us. We appreciate you. And we can't wait to see you in June. More than likely, it's going to be actually a client appreciation brunch. So it might be live from outside this building with beautiful barbecues, but we haven't finalized it yet. Regardless, we'll see you in June. Until then, take care and reach out to us directly for all the resources. info@reccanada.com. See you then.